Welcome back to Sunrise. Declined, but why? Many ask this question while our financial educator, Carlton, delves into the factors that can lead to loan rejection, giving us some insight into that will help us to make some more informed decisions and even improve our chances of securing financing in the future. Carlton, over to you.
Good morning.
Good morning, sir.
Good morning, people.
How are you?
I'm doing good. I love the fact that this segment is now after breakfast. Yeah, I'm waiting because last week I got a shot before I started.
Yeah.
Some money, there's a muffin coming over. Dennis,
Give you a little hookup with some of that tamarind compote. Yeah. That will give you a kick.
Trust me, and I'm waiting on that right now before we start. Right. But until then, let's jump into it. So for many persons, you will apply for a loan at some point, and you may have heard declined or no, or just, get the loan. And then you may ask, what are the reasons? Sometimes the banks will just tell you, you are not qualified at this time. But persons sometimes wants to know why. What's the reasons so I can work on it? So let me help you. What are some of the reasons why the banks or the lenders will say you can't get the money? Let's jump into it this morning. So the first one is insufficient funds. You're not earning enough money. You don't really have the money. So literally, you're broke right now for what you're asking for. And that may not be what they want to tell you up front, but something you don't have enough money. Which leads into number 2, which is the impact from your debt service ratio. I would have mentioned this some time ago, maybe early January, but didn't get into the details of that. But what is your debt service ratio has to do with anything at all. Whenever you apply for a loan from a bank, the bank will look at your income and then all your other debts obligation. And then you need to be using only 45% of your gross income as loan repayment, including the existing loans and the loan that you're applying for right now. Let's jump into a nice quick example. So you earn $100,000. That means 45% of $100,000 is $45,000. That means this is your maximum that you should be paying with debt obligations, which includes your mortgage, anything that you currently have. You come in now, you want a car. You say, Carlton, I want a car. I want a car for $2 million. Boom, I take out my calculator, and I tell you, a car of $2 million will run you $43,000 per month. Your debt ratio is $45,000 right here. But you also have a credit card of a limit of $100,000. And with banks, you will take in 5% of the limit. In this case, it's $150, so it's $6,000. Is 5% of the credit card. So even though you're not using the credit card, you still have the credit card. But the banks will factor in the fact that you have this credit card, and the minimum payment is 5%. So that is $6,000. When I add this $6,000 of the credit card that you already have, and this new car payment that you want, may I say, but hold on, that's $49,500. You can't afford this car. Loan is declined right off the bat. So we will sometimes say, here what, get a cheaper car. So if I drop the car to maybe a $1.5 million car, it's $33,000 a month. Everything comes to $39,000, which is less than the $45,000 here. So that means you're now better able to afford this facility. So sometimes when they say, get a cheaper car, or they may say, reduce your credit card limit so you can qualify, do not feel...
Right, because I was thinking like sometimes we have, I have a credit card, $1 million on it.
And we don't realize that that impacts our ability to borrow. So you want to factor that in, and that's how your debt service ratio actually works. And you listen sometimes when the banker speaks to you, reduce the credit card, just listen because you want to secure the financing. One other thing is the lack of collateral when you are borrowing. So if you are taking on an unsecured loan, that is totally different because there's no security attached to that loan. However, if you're borrowing to buy a house or a car, you sometimes can be declined if the asset is not suitable to the lender. So you may be buying a car and the car is too old. The bank doesn't want to take on an old car, so your loan can be declined. So if the car sometimes is over 10 years old, insurance companies will not comprehensively insure a car sometimes over 10 years old, and the car must be insured comprehensively. So if that is the case, the bank will say, wrong, you're not getting the loan at this time. Also, you're buying a house, but the house is not in an area where the bank thinks that the property is of resaleable value, or the value will not increase to cover the loan just in the event of. Or if you do not pay, will somebody want to buy this house located at this particular area? I will not call any names. But this is the harsh reality of where we currently live.
But isn't it such a catch-22 because, you only can afford X amount for the car. They're not going to insure the vehicle, but a car younger than 10 years is going to cost you more. You can't afford the house. You can get another house in another area for less, but they don't want the house in that area because of the risk. It's a catch-22. What do we do?
So what they will say, here what, I will finance less on this house and you find more out of pocket. Because just in the event that when you can't pay the loan, for example, and we have to sell, you cannot get premium price for a house in a particular area. Because the reality is, if this house is on the market and I say, Dennis, one nice house here over X, Y, and Z, Dennis is not going to buy the house. You indeed talk the truth, you're not buying the house because you're not living in a particular area. So because of that, it's a difficult space to be in when it is that you are financing assets of a certain value at a certain place and location. So think about that as well. And the banks or lenders have a responsibility with depositors' money to ensure that if I lend the money and you can't pay, I must be able to be in a position to replenish the money in case you want back your money. Because I remember the banks lend your money. All right? Number 4 is the loan purpose. If the purpose makes no sense, if the purpose is not where the bank needs to be. So for example, you're taking a loan of $1 million to do some home renovation right now. But when we look, you can't afford $1 million, only $300,000. They may say, here what? This $300,000 is not sufficient to do what you want to do, so I will not approve because the purpose doesn't make any sense because of the value that you can now afford. And they will not underlend. Because if I underlend you at this point in time, you will particularly maybe run up debt somewhere else because you want to finish the project. So if the purpose doesn't come together, they will not lend as well. So
you have to scale down the project.
Your jobs, you have to scale down the project or just scrap it altogether and reel and come again. Number 5, your job stability. If you're not at a particular employer for a little while, or the company that you're now running, is fairly new, there's no history of performance. So there's no dependability on your income from this source. That can be a challenge to lenders as well, and you need to be aware of that. So if you hop from job to job, 3 months at this job, 2 months at this job, that's not a pretty picture, so you want to be. And the last thing is your credit report, and I've done this in depth already. Your credit report is important. Some of the challenges on your credit report can include your late payments. So you're not paying your current debts on time. You pay when you feel. If you feel the due date is the 1st of the month, you're paying on the 25th, the 6th, the 7th, the 8th, the 9th. You have to. You also need to look at if you are not paying in totality. Sometimes you have persons who you know your payments should be made, and you're saying, well, this month I'm going to pay your courts, so the bank can't get to pay this month. Next month at JPS time or NWC time. So you're paying hopscotch with your loan payments. And once you are doing that, that's a challenge that will impact the bank's decision. And lastly, if you have ever had written off debts. So if it is that you were not paying a particular loan and the bank had to take you to the court, for example, and just say, hey, well, it's not going to win. You could write off this debt and let Dennis go about in business.
You might think it was a good thing, but
it's not a good thing. It's going to haunt you in the future. So if it is that you have ever had a loan written off, please follow up with your lenders. Nonetheless, if you intend to secure a loan in the future for maybe a house or your car, the reality is you can use debt to push start wealth building. So you need to be able to get credit just in the event that you want to buy a house or buy a car. So if it is that you need anything else, you know where to find me. So I'm over there on Instagram at Carlton G Stew or over TikTok or Twitter. And let me help you to secure financing to push your life forward till this year we're going.
All right.
Everybody.
Sounds good. So get your waffle, Carlton. I got you. Stick and stay. Diaspora Link Up is up after the break.